Yo, what's going on, guys? Welcome back to a new video. Inside of today's video, we're going to be covering my 90-minute tCISD model, also known as the freedom model, the model that has allowed me to get many payouts and also pass many funded accounts. But not only myself, it has also allowed lots and lots of traders to become profitable and request huge payouts. So that is amazing to see. So I feel like it would have been a little bit rude not to sort of cover it again and go in depth within the model just that little bit more, show you guys a few examples on the charts as well of it playing out in real time, and also getting a little bit more in detail, telling you guys when you should be taking the model, when you shouldn't, and all that sort of stuff. Okay, so without wasting any more time, let's go ahead and jump straight into it. So the first page, elements behind the model. So there's 4 simple steps behind this model. Number 1 is you must have a clear bias / draw on liquidity. And this means you must know where price is heading before it actually gets there, right? You must know which high or low price is trading towards. And you want to know the narrative, why price is trading towards there. Once you've got all that figured out, which, by the way, we're going to get into detail of every single one of these steps as well in just a moment. Just think of this part here as like your checklist first, okay? Step number 2 is once you know where price is heading, then you're going to be looking for a sequential SMT, a SSMT, which is a cracking correlation between closely correlated assets, indicating a shift in direction. So step number 1, we know where price wants to go. Step number 2 is that indication that price is ready to start trading towards the high, for example. Step number 3 is then our true change in the state of delivery, our tCISD, which is a confirmation tool of our sequential SMT. And all it is a candle closure above or below the candle that created the SMT, okay? Step number 1, know where price is going. Step number 2, wait for that indication of the shift in direction towards our drawn liquidity. Step number 3, use the tCISD to then confirm the sequential SMT is likely to hold. Step number 4 is the final one, the timing element. All trades must be taken within the window 9 to 10:30 Eastern Standard Time. Right, you can trade this model any time of the day. You can even find your own specific 90-minute windows. That's completely fine. However, the one that I personally trade, the one that I have got most of my data with, is between 9 to 10:30. However, it does work 24/7, okay? And what I recommend to my students as well that can't trade the 9 to 10:30 window is they pick another window, a 90-minute window, so a 90-minute quarter, either Q2, Q3 of London session, Q2, Q3, or Q4 of the AM session, or Q2, Q3 of the New York PM session. So pick one specific 90-minute window that works with your schedule and then stick to that day in and day out. Before that time window starts, you don't look at the charts, you don't take a trade. A minute after that window is over, you close down the charts, you get on with your day, okay? Simple as that. This is then going to eliminate any potential over trading. Also, the model itself is only going to be able to form a few times within that window. So you're not actually going to be able to over trade and take dumb trades, because until the model's there, you're not going to take anything, okay? But before we do go ahead and get started, I just want to mention something to you guys that I've never done before. As you guys may know, I do run a one-to-one mentorship, the Quarterly Mastery Circle. And as it is coming up to Black Friday, we're going to be giving away one spot completely for free. By the way, we charge thousands for this mentorship, and one lucky winner can win this completely for free. But it's only for people that are really locked in, that actually want to transform their trading. We've taught many traders from non-profitable to over $500,000 in funding in just 2 months. So if you guys like the sound of that and want to be a part of it, I'll leave a link below in the description. Top link in the description. Go ahead, click on that and just fill out a small form. It won't ask you for any, credit card details, anything like that. Just a form, and then you will be applied and you will be notified if you are the winner of the free one-to-one mentorship slot, okay? But anyway, now let's jump back into the video. Now we've got our checklist. Let's go ahead and break down each individual part of the checklist one by one, so you guys know exactly what you are looking for, okay? So step number 1 is that bias, right? So the way that I find bias is very simple. There's 4 simple tricks that I use, right? And you don't need to use all 4. This is just more or less if you want to be super advanced. You could literally stick to number 1, which is daily candle closures, and just call it a day. But obviously this is for people that want to increase that win rate, want to get that higher level of precision. So step number 1 is daily candle closures. So if you haven't already, check out my daily bias YouTube video. There's one in the bootcamp and there's one just elsewhere on my YouTube as well. If you just search daily bias, go ahead, watch that video. It will essentially show you visual representations of how each daily candle closure should look in order to know if we're going to get reversal, a continuation, if we're consolidating, all that sort of stuff. Essentially, it is if price closes above the previous candle's high, the wick, then we can expect a continuation the following day. If it wicks above the previous day's high, but fails to close above it, then we can expect a reversal. So I just sort of apply those, but then we add the cracks and correlations as well, right? So number 2 is monthly cycle or weekly cycle SMT, which, as you guys know, if a weekly cycle occurs, for example, between Monday and Tuesday, that can then give us the bias for Wednesday, potentially even Thursday, and potentially even Friday as well, okay? Because think in terms of distribution, continuation, and then a potential discontinuation higher again within the final quarter, okay? Step number 3, we've got daily time frame, PSP/SMT fill. So again, just go to the daily time frame. Have we printed a PSP? Have we got an SMT fill? These are all cracks and correlations that can allow us to know when price is going to shift direction or if we're going to get an expansion, for example, okay? Number 4, the final one, the most simple one, is are we respecting or disrespecting a raise, specifically on the daily time frame? So do we have a bullish daily gap? Are we trading inside of it and then rejecting higher from it? If we are, that is a very simple way to know that we are still bullish. But if price closes below that gap, disrespects it, then we can be thinking, okay, we're probably going to have a shift in direction here. The daily time frame may shift to bearish now, okay? So again, note these all down. Just keep mental note of them. It takes 2 seconds to open up your chart, go to the daily time frame, and just look for these 4 simple things, okay? So do that, keep that in mind, and you'll be good to go. Number 2 is draw on liquidity. Now, the 4 draws on liquidity that I use is previous X highs and lows. So X means previous day high or low, previous session high or low, previous 90-minute high or low, previous week high or low, previous month high or low, okay? All sequential, all previous week, month, year, day, session, 90-minute window, micro session, okay? You guys get the point. Those are obviously usually very great targets. Number 2 is unmitigated gaps. So what this means is a gap that has formed within price and that we haven't traded back into yet, okay? So essentially just a wide open gap. Price has not traded back into it yet because we know that usually price does trade towards the gaps. It rebalances the range and then trades higher from there. So we can take the trade away from the gap, but we can also take a trade towards the gap in anticipation that it will get filled, okay? Number 3 is premium discount, a raise, and liquidity. So literally pull a fib from the high to the low of like the dealing range. And if we're in a premium, mark out your discounted liquidity, discounted fair value gaps, order blocks. The way that I like to find premium discount is previous higher time frame quarters range. So if we're trading the daily cycle on a Wednesday, for example, literally go to the hourly time frame and mark out Tuesday's range, low to high, and then boom, that is our premium discount for the entirety of Wednesday when looking at the daily cycle. And you can mark out those liquidity pools in a premium, the fair value gaps, all that good stuff, okay? Because we know that price likes to go from a discount to a premium, premium back to a discount, right? Number 4 is previous candle high or low. So same with like the previous X highs and lows, previous quarter high and low. Those usually do align with the previous candle high. For example, previous day high or low is, again, you know, if you're trading Wednesday, then that is Tuesday's high or low, for example. But yeah, like this is a video that I'm going to go more into depth with as well, like the previous candles highs and lows, because understanding the anatomy of a candlestick is very important. And it's something that I use within my trading, like a very, very large amount, is if you go to a chart, there's always something that you'll find in common, and that is the previous candle high or low usually always gets traded to. So if you're trading, for example, an hourly candle at 9 a.m., for example, and it hasn't taken 8 a.m.'s high or low, you know, if you can identify which one it's going to go for first, you can look for the entry model in line with that. And like I said, there's a very high chance that it will take that previous candle's high. So it's almost a guaranteed, like, not really like a guaranteed TP, but a guaranteed trade that could occur within price, right? If you've got like an 80% chance of knowing the 8 a.m. high is going to get ran during that 9 a.m. candle, and you look for this 90-minute tCISD model in line with that, and just take TP at 8 a.m. high and potentially even runner, then you're going to be ahead of 99% of people just with that knowledge in mind, right? So yeah, those are the draws on liquidity. Having a clear draw on liquidity is key. First, identify where price is headed. Then that's when you can focus on your entry, which is what we're going to jump into now. Firstly, once we've identified where price is going, now we're looking for the entry model, which is a simple sequential SMT within 9 to 10:30 window, and it can be a daily cycle, a 90-minute cycle, or a microcycle. It doesn't have to be all of them. It doesn't have to be two of them. It can only be one. It can literally be a microcycle, that's it, or it can be a daily cycle and that's it. The reason is, excuse me, the reason is why it can be any is because once we've identified that drawn liquidity, we don't need to wait for 2-3 stages of sequential SMT to form to get into the move towards the draw, right? Like, you only need one. As long as you can clearly identify that price is traded lower, form some sort of sequential SMT. So, price is here, right? It just drops a little bit lower, maybe at 9:30, for example. It's formed a microcycle. Maybe the daily cycle low is like all the way down here. So it logically doesn't make sense for price to go from here all the way down there. This is then when we're looking for the microcycle here, for example, right? And I don't know, let's say there's a 15-minute gap to our left as well, even higher probability. It takes it, and then boom, our drawn liquidity is all the way up there, and it just trades straight to it, okay? So just think, like, does it make sense to go all the way for the daily cycle low? Or does it make sense just for a microcycle to form? Usually if the draw's very, very close nearby, it doesn't need to manipulate that far. Just a small little wick lower, microcycle, or a 90, and then boom, off we go, okay? Also, a thing to keep in mind is if we're waiting for a microcycle to form and all assets run below the previous microcycle quarter low, right, then we know that we can't get a microcycle sequential SMT. So then we work our way down. Okay, cool, we can't get a micro, so now we're waiting for a 90. Oh, all assets traded below the 90-minute low. Now we know that we're looking for daily, right? So you can do that like process of elimination as well to help you know which sequential SMT is going to form, which one's going to hold, all that good stuff, okay? So it can be one or multiple. Once the drawn liquidity is clear, only one is needed. Bullish sequential SMT takes place below the true open, as always. Bearish sequential SMT takes place above the true open, as always, okay? Super, super simple. If you don't know what a sequential SMT is, go ahead and check out my SMT video on my YouTube channel. It's literally the very first video that I ever posted. Scroll all the way to the bottom. Go ahead and take a look at that one, okay? So now, one sequential SMT. What comes after that? A true change in the state of delivery, a tCISD. So now, what a tCISD is, for example, a bullish tCISD is a candle closure above the candle that created a bullish sequential SMT, and that candle must be bearish. So here's a visual representation of a bullish sequential SMT, right? Which candle first ever created the sequential SMT? It wasn't this one. It wasn't this one. It wasn't any of these. It was this very specific candle here that we've marked out the open of. If you draw a straight line, boom. That very candle created the sequential SMT first. So then, in every single case, that candle itself is our tCISD candle. But the catch is, in a bullish sequential SMT, this candle has to close bearish, right? If it does that, cool, mark out the open, wait for a close above, and then you're good to go. However, if, let's say, for example, this candle that created a bullish sequential SMT closes bullish itself, then we look to our left within price. So we're looking left, 1, 2, all left here, right? Then you just mark out the most recent bearish candle, okay? The open of it. So if this one closed bullish and this one closed bearish, mark out this candle's open, wait for a close above, boom, we have our tCISD confirmed, and now we have everything that we need. And then in the case of a bearish tCISD, a candle closure below the candle that created a bearish sequential SMT, and that candle itself must be a bullish candle. So literally it's just the opposite, right? So bullish sequential SMT, the candle that created it has to be bearish. If it isn't, look to your left, look to the most recent candles, mark out the most recent bearish one. In a bearish case, the candle that creates sequential SMT has to be bullish. If it doesn't close bullish, look to your left, mark out the most recent bullish one. Always mark out the open of the tCISD candle, and then wait for price to close below it, okay? So here, the tCISD candle, we know it's there, but 1, 2, it wasn't confirmed off these two following candles. It was finally confirmed off this one, and then your entry is essentially just back inside a retest of the tCISD candle. So this one candle, mark it all out, price wicks in once, twice, and then off it goes. You can see a gap overlaps with it as well. That isn't 100% necessary. That just increases the probability of this setup here specifically holding, okay? So now you guys know everything that you're looking for. Let's go ahead and jump into a few examples right here. So, oh, actually, no, never mind. We're missing literally the most important part. well, essentially kind of the most important part. If you do want to increase the win rate of the model, like I said, you can trade it any time of the day, even during Asia, but the time element is what makes this very, very high probability. So 9 to 10:30 a.m. in Eastern Standard Time, which is New York AM time. Wait, New York AM? Just New York time, sorry. But it is within the New York AM session. That's why I said that. So the reason why I chose this timing is obviously it is a 90-minute quarter. It is Q3, but it lands perfectly within Q3 of the daily cycle. So it's Q3 daily cycle, Q3 90-minute cycle. As you can see, Q3 within Q3. And what do we know about Q3? Q3 is generally one of our highest probability quarters. It will often offer like the main bulk of the candle. It'll often offer the distribution. If it doesn't, it will usually give some clear manipulation and then begin distributing right after, okay? So within this time window, not only that, we have many volatility opportunities, specific trading indices for the open, but for the rest is completely fine with forex and, you know, commodities, all that stuff. Actually, the 10 a.m. open isn't there on those, but either way, it is still a very high probability quarter, but more or less better if you are trading indices. So we've got that 9:30 open, 9:45 news, 10 a.m. 4-hour candle open, and also potential 10 a.m. news, okay? So we've got the chance of potentially 4 volatility windows just within that small, tiny 90-minute window itself, okay? And even if we don't get 4, there's guaranteed 1 at least every single day because 9:30 is always going to open, right? So there's guaranteed 1 volatility injection every single day, as opposed to trading a random 90-minute quarter within Asia. There's no guaranteed volatility injection. And in fact, I don't think there's ever any volatility getting injected at that time, right? So this is why I chose this specific window. Not only because it's Q3 of Q3, which is the bulk of the candle most of the time, but we've got many volatility opportunities, and also these volatility windows specifically. If you see those specific timings create, for example, a sequential SMT and then a tCISD model, those are very usually high probability. Like 9:30 may open up and clearly manipulate some lows, creating a nice 90-minute tCISD model, or 9:45 may manipulate and create a nice 90-minute model, right? So it's all combined with those timings to make it even higher probability, okay? And if we form the model prior to those timings being released, the 9:30 open, then you can expect the open, for example, the 9:30 open to distribute, right? So if you form the setup prior, you can take it, stop on the SMT low, and then literally ride that 9:30 distribution higher, okay? So with that being said, that is now covered everything within the actual model itself. So let's jump into a few examples we've got down here, okay? So this is example number 1. This is a daily chart, right? So purely looking at daily candle closures, this is what I mean. You can just use daily candle closures alone. In this case, this did close as a PSP as well. But what type of candle closure is this? So it wicks below the previous day's low, but it fails to close above it and closes back inside of this candle's range, okay? So it wicks below here, but it doesn't close below here. It fails to close below here. This is an indication of a reversal. So this is a bullish reversal candle signature. So we can come into this day here expecting higher prices, okay? Think of this day as our manipulation, and then we're using the cracks to sort of confirm that as well. So in this case, it closed as a PSP. So we've got a crack, we've got a bullish, obviously indication of a reversal, and then we're expecting distribution within this day here, right? So all we're doing is just, if we know we're bullish or very high chance we're bullish, we're waiting for this candle to open up low, put in a high, and then close, right? So on that low, essentially, if possible, when it's put in that wick, or as long as it hasn't printed like a large expansion body already, then we're looking for the 90-minute tCISD model, specifically in line with our bias. We're not going to go against it. We're going to trade only in line with our bias, right? So then you can see, look at the timings at the bottom. I apologize. Hopefully I can remove this blue line. There you go. You guys can see the timings at the bottom there. Obviously, we don't start until 9 a.m. But what happens at around about 9:18, we can see that price drops below Q4 of the microcycles quarters low at around 9:18. Then we get our tCISD form slightly before 9:30. It looks like it formed around about 9:28. So then, you know, you mark out the tCISD candle. Price retested tCISD at 9:28. It looks like once again at 9:30. But your stop loss ideally goes on this sequential SMT low, right? So here's our tCISD. Mark it out. Price closes above it right there. But again, we enter off the retest. So we wouldn't have entered here. You can if you want. The RL wouldn't have been as, you know, as good. But then once the tCISD that you marked out is getting retested, wicked, We wick below the body of it, but as long as we don't close below it, then it's still valid. So then you would take your entry here, stop would go on this sequential SMT low, and then as you can see, 930, like I was just mentioned just a moment ago, tCISD model prior to 930 equals 930 distributes to the upside, okay? And again, below, you know, the true micro session open, all that good stuff, right? Now let's jump into a second example. Here is a daily chart right here. Here's our continuation candle signature. So this day here closes above the previous day's high. So what does this indicate? A continuation within this following day right here. Again, we'd expect an open low, high, close. And this is what I was meaning, like the previous candle high is almost a guaranteed place for price to trade to once you've established your candle closure, right? So if you got the continuation one to the upside, this high is almost guaranteed. For example, in the previous example, the reversal one, the candle that created that reversal, that candle high, candle number 2 high, is almost just like a guaranteed place for price to trade towards, sorry, right? So if that hasn't been taken and you're still trading that 9 to 10:30 window, then you're just golden. You know, it's very, very high probability. So either way, here is our time window at the bottom, as you can see, 9 to not all the way to 10:30, because this again is just a microcycle, the 1 minute chart. These are my favorite. Usually there will be like a daily cycle and a 90, like one of those and then a micro. So you usually have around 2, but honestly, just one micro alone is completely fine, okay? So as you can see, 1 minute chart, in this case, it was between Q1 and Q2. This actually is confusing for a lot of people. Can you see this is a sequential SMT, right? But this asset specifically here created a failure swing, right? This is a failure swing sequential SMT. So that means if we're marking out our tCISD from here, let me see exactly where it's marked from. Yeah, it's marked from this candle here. But you can see this candle itself didn't run below the previous quarter low. All that means is this candle on the asset that did run below the low, that is our tCISD candle. So say for ES, for example, this specific candle, imagine wicking all the way down there, runs out the low. So on ES, if that candle closes bearish, that would be our tCISD candle, okay? But also we can replicate that within the asset that failed to run below the low. So NQ, for example, failed to run the low. But this is why you got to be looking at multiple charts so you know the specific time of the tCISD candle on ES. Once you've found it out, it looks like on here is around about like 926. Mark out the very exact same candle, the open of it on NQ, the one that created the failure swing. Wait for price to close above, which it did here around about 927, it seems like. And then we wouldn't take an entry here or here. We would take it off the retest. We retest the tCISD right there. Boom. Stop goes on, in this case, the failure swing sequential SMT low. As you can see, it doesn't get run out. We take the entry at the tCISD, stop on the low, and then boom, just let that run, okay? So how are you guys feeling at the moment? Are you guys sort of, you know, getting the gist of this model now, seeing how powerful it really is? Hopefully you guys are, but that is going to do it for today. Remember, we are giving away a one-to-one mentorship slot, which costs thousands completely for free for our Black Friday celebration. Remember, link below in the description. So if you guys do want to learn this model more in depth and trade alongside me using this model every single day, this is going to be your opportunity. But yeah, with that being said, hopefully you guys did find this useful. Let me know if you would like sort of like a part 2 to this, where we just dive solely into charts and just do a charting session looking for this specific model. We do also have backtesting results of this model. It's a little bit tweaked to just a 90-minute cycle only, but check out the 90-minute tCISD backtesting results, and you can see already just from one bad month of backtesting, we got some insane results. So if you guys are sort of on the fence of trading this model, then that should push you over the fence. But with that being said, hopefully you guys did find this useful. If you got any questions for the model, do let me know in the comments down below. Also, don't forget to check out my socials, link below in the description, as well as my Oracle X AI trading journal, my premium membership group, both the indicators. And yeah, with that being said, do enjoy the rest of your days, and I'll see you all within the next video. Peace out.